This is Radio Entrepreneurs, and my name again is Jeffrey Davis. I'm the host of the show. And as I always like to remind our great audience, we are dedicated to sharing the success of entrepreneurship, but also continuing the success of entrepreneurship. The success of entrepreneurship is something that we hope that continues for a lifetime. And when we're talking about lifetime success, we're talking to Richard Greene, our reporter from Centerpoint Advisors, on financial matters. Hi, Richard.
Hello, Jeff. Good to be here.
Thank you very much, Richard. So what's the important story today that's going to keep all of us comfortable?
Well, I thought I'd do, we're sort of past the halfway point in the year. It's been an interesting year. I think at the beginning of the year, people would be suspect that we'd still be in positive territory because this is our sixth consecutive year of the market being positive. The S&P closed yesterday a little bit more than 5% or so. Bonds are actually up this year, surprising everybody because the benchmark bond yield is typically referred to the 10-year Treasury bond, which ended last year at a yield of a little over 3%. Right. It's currently under 2.5%. So what we find interesting is you have the bond participants thinking that this economy isn't really gaining a lot of traction very rapidly, but yet the market keeps on marching on. And the interesting thing about
despite conflicts all over the world,
geopolitical, that's what they call it, either the most hated bull market or the Teflon market. Nothing seems to stick in terms of other than a brief correction. So investors, I think, are rightly concerned. They're trying to take some risk off their portfolios. They've benefited from the huge advance. They see signs in housing and employment that are constructive, but it doesn't feel like we're back into the go-go days and the glory days. Jobs are still challenging. Companies, despite their very liquid balance sheets and improved liquidity and options, they're not putting a lot into capital spending. What you're reading mostly about is strategic mergers and acquisitions, and you know what the end result of that is. When Family Dollar Store and Dollar General merge, there are efficiencies that they're looking for, which is oftentimes comes at the expense of jobs. So it's still sort of a balancing act. There's signs the market is telling you that things are relatively healthy and moving forward, and yet it's still posing problems for some people in the job market or trying to get credit, things like that. So what is an investor to do? You know,
right.
What's a practical thing? I think you have to.
The investors I know are still a little jumpy right now. They're waiting for the shoe to drop.
That's a good way to put it, and that's not necessarily an inappropriate term. There's two ways to approach it. One is allocate monies to your investments as an inflation hedge that you know can stay there 5 to 10 years minimum, and expect the market to do its thing. Or alternatively, make sure you keep ample cash and a healthy fixed income position. You know, plenty in bonds that will.
So you still believe in holding some cash?
Yeah, cash allows you to be opportunistic.
Right. We
may wake up one day and all of a sudden see bonds rising that we can now get 3 or 4% on a 5-year bond, which is twice as much as we've been earning for the last couple of years. So that you want to be opportunistic. The challenge with cash relative to equities is that when you're in the midst of a correction, it's very hard to have the gumption to sort of step in. But the strategy that works, we think best, is you come up with whatever your allocation is. And when you have, let's say 50% stocks, 50% bonds. Now, if you've been an investor for the last 3 years, you don't have 50% stocks anymore. You have 65% stocks and 35% bonds. So one of the hardest things for people to do is rebalance, leave the party, take profits off the table, and pay Uncle Sam. However, in the long run, that's the right thing to do. If we revisit 2008, if you were 50% stocks, 50% bonds, you weren't 50-50. You were 30% stocks, 70% bonds, because the value of your equity portfolio diminished significantly. What would you have wanted to do then? Get back to the 50-50. Again, very hard to do. So in real terms, what's happening now? Pension funds and large institutions who have very strict investment policies are taking a hard look because they have guidelines that they can't violate. So if they're, say, 50-50 or 60% stocks, they've had, I think, some of the headwinds that we're running into is the fact that institutions, by mandate, really have to rebalance and say sayonara to portions of their equity long-term growth portfolio just to keep in balance in the event we have a significant drawdown or correction.